Coming up today, why the Dean of Valuation just says keep buying. Can anything stop US exceptionalism? Black Friday sales surge. South Korea went into martial law. Oil gets a bump up. And why you need to pay attention to the best companies to work for. Let's go, guys. And welcome back to the Daily Market Review, everybody. Another low-range grinding day higher on the S&P 500. Starting to look like we may go into that low volatility grind-up mode. Actually very similar to what we saw this time last year, going back to late November, early December 2023. My S&P 500 oscillator went into overbought territory and it just stayed there, and the market was grinding higher on this low volatility. Lasted a few months, actually. All the way throughout Q1, we didn't really get a pullback until early April. And that was brief as well, just a few weeks before the market kept on grinding higher. Then we got that seasonally volatile period in Q3 that we can often see before we went into the bullish seasonal period of Q4. And just looking at sector performance today, once again, a lot of dispersion. Finished the day with tech up almost 1% and utilities diving into the close, finishing down 1.68%. And we actually continue to see a little bit of a consolidation and slight pause here in the Russell 2000 small caps, just consolidating at all-time highs. However, just like yesterday, we got a bit of a continuation in the rotation into mega cap tech, the largest companies out there. As a group, breaking out to all-time highs, up collectively over 1%. Being led by, once again, the largest company, recently taking back the crown from NVDA, Apple. All-time highs here, even as Warren Buffett offloaded more than half his stake this year. And they just missed on their recent earnings. Market's still not sure on iPhone 16. However, here we are, market cap 3.67 trillion. NVIDIA's had a little bit of a bounce back. Same with Microsoft. Amazon sitting at highs. Alphabet has been the weakest, but probably the best valuation here, in my opinion. But look at that with Meta as well, up 3.5%, brand new all-time highs here. And so once again, this market is firing on all cylinders. This year we've really seen small caps and mid caps make a comeback, just break out to all-time highs. Now we've still got the leaders from last year and Q1 this year, trading on firm footing as well. And so I thought on the back of that, it would be interesting to give you guys a little bit of a background on Aswath Damodaran, also known as the Dean of Valuation. He's a finance professor at New York University and their Stern School of Business. And he's someone I've been following for years. He's a very smart guy, deserves the label the Dean of Valuation, and he shares a lot. This is his webpage on the New York University. Links to a lot of papers, even shares data and simple tools. He has a great YouTube channel. In fact, he's uploaded over 1,200 videos. Very technical guy and can speak at length and in detail on all things to do with valuing businesses and other corporate finance subjects. He also has a great blog as well, Musings on Markets, which he's been running for years, and he still regularly writes blog posts. And so it was interesting to see the article headline from him today, top tech stocks are cash machines, so keep buying. And so I'll play the rest of this interview he just did with Bloomberg Television. I thought it was pretty interesting, some of the points he makes. So this just goes for a few minutes and check it out.
How are you looking at how markets are assessing the risks out there?
Yeah. If you think about markets, there are two games that go on in markets. One is what I call the pricing game. It's driven by mood and momentum, and there really no fundamentals don't even matter there. And there's the investing game. You talk about fundamentals. The balance shifts over period. This is a pricing market. The reason I think fundamentals don't even come into play is when mood and momentum is this strong, they steamroll everything. So I think at the moment we have a pricing market where traders are driving the game. And traders really don't care. I mean, they might pay lip service to earnings and cash flows, but the truth is, they really don't care. It's all about mood and momentum.
Mood and momentum, and you see that for the MEG 7. No stopping the MEG 7. And you say, find that opportunity to own a MEG 7 stock.
Yeah, and I think in a sense, I have never seen a group of companies carry a market for as long a period as the MEG 7, or the FANGAM, as I used to call them in the last decade, carried this market. 15% of the gain in all U.S. equities across 7,000 stocks has come from 6 or 7 companies. The numbers are mind-boggling. You know, we're talking trillions of dollars in market cap added every year. The MEG 7 companies alone, if they were a market, would be the second largest equity market in the world after the U.S. equity market. It's that big a chunk. But when you have mood and momentum, it's often built on some reality. The reality here is these companies are special companies. They've been able to scale up not just revenues and growth, but some of them are insanely profitable. NVIDIA has gross margins of 75%. I mean, that's outlandish if you think about it. You know, the operating margins are 60%. These companies, at least most of them, are cash machines. And so if you're thinking as a value investor, I've never seen cash machines as lucrative as these companies are. And I don't see the cash machine slowing down. I think the pricing might be getting out of control, but they are pricing in companies that are deservedly among the best companies in the world.
And so I agree 100% with what he said. He acknowledges both the exceptional fundamentals of the Magnificent Seven stocks, but also how he differentiates between two markets. One where investors are focused on the fundamentals, and the other being when mood and momentum has taken over. But like he says, these companies, including NVIDIA, are insanely profitable. The fundamentals are exceptional, and we've also got the mood and momentum of the market. Unlike the late 90s, where there was definitely a lot of mood and momentum, but the companies back then weren't the absolute cash machines like they are now. And just look at the concentration in the S&P 500. Magnificent Seven, now third of the index. So how much longer can this US exceptionalism continue? As we've recently broken records in terms of concentration, outperformance versus the rest of the world. A lot of people calling for a big reversion to the mean simply because we're so stretched. And you can see that in this chart here. The MSCI US index versus the rest of the world since 2009. It's like night and day. But it's not just these tech companies. US GDP growth has been above that of Europe as well. And just like that article said, American exceptionalism is gaining momentum and could have a lot further to go. Because there's already been US exceptionalism without all these American first policies and a huge amount of red tape and regulation. So if all that gets loosened up, who knows, maybe US exceptionalism can continue well into the 2030s and beyond. And apologies to my European friends in advance. I'm not trying to insult you with this chart here, however, just to put it into context. Because like I said, when I first got into trading, the US and EU were neck and neck in terms of size, liquidity, importance, and tension. However, there's been such a massive divergence in those last 2 decades. You now pretty much got single US companies greater than entire European markets. In fact, just looking at large cap companies created in the last 50 years, no better chart shows the pace of innovation coming out of the States versus the European Union. Now, I think there's a number of factors driving this. First off, in my opinion, there's big cultural differences. In the US, there's a real drive and hustle to financially excel, and you can always level up to the next level. There's a real competitive spirit and a desire to win and be the best. Whereas generally speaking, a lot of European cultures are more laid back, seek a better work-life balance, are not so much into the hustle and grind, happy to take month-long holidays, and actually just enjoy using US tech while not actually working around the clock to make it. The US is also an easier place to do business, better regulations and taxations. Like I said, that's about to excel on the upside, whereas a lot of Europe markets are overregulated, overtaxed, amongst other socialist policies. Also, energy in the States is a lot cheaper than Europe, again, generally speaking. Electricity is a lot more expensive in Europe. I think the Fukushima accident in 2011 in Japan was one of the worst things to happen to the world. Not only just for the local environment there, but more the political knock-on effects it had. Because after that, Germany, Europe's largest economy, turned its back on nuclear. In fact, they phased out all their nuclear reactors, almost going all in on relying on Russia for their energy, for which they were warned about. However, they laughed back in the faces of those warnings, and now they realized those warnings were indeed correct. Other European countries turned their back on nuclear. However, some of them are starting to come back, led by France, and they eventually all will. However, Fukushima hadn't happened, and they had a bit more foresight with being energy independent instead of relying on Russia. They could have been the world leaders in nuclear. They've done well in wind and solar, but nothing beats nuclear, and so I think they've been pushed back a decade or so after Fukushima. And so hopefully Europe's best days aren't behind it, as its size and importance goes further down and down every year. Asia quickly overtaking it. Maybe things can change and innovation can come back, and we can start seeing some big European companies in the technology sector. Otherwise, I don't see US exceptionalism and their dominance in technology going away anytime soon. And so those exceptional fundamentals on top of a bull market, it's no surprise that most of them are at all-time highs. And the US economy continues to defy expectations. Been a big narrative of a recession for the last 2 years now. Once again, hasn't materialized this year, as retail's having its best Black Friday and Cyber Monday ever, shattering expectation. Estimated 197 million people shopped online or in stores from Thanksgiving through Cyber Monday. That is nearly 14 million more than what research projected. Retailers are feeling positive about the holiday season, and online sales from Thanksgiving through Cyber Monday were up 8.2% from last year. It's more than double inflation, so that's real growth there. And in fact, just looking at the Red Book Index, it's a measure of retailers' same-store growth for stores that have been open longer than a year, just broke out to a one-year high, 7.4% year-over-year growth, looking like it's in a clear uptrend. We also just got better than expected job openings. The amount of available jobs in America is more than what economists were expecting. US labor market is holding up. I'm sure a lot of you guys remember just 2.5 months ago, we got a little uptick in the unemployment rate. People were calling for an emergency 50 basis point cut from the Fed, some saying saying 75 basis points. Jay did end up doing a 50, but things are still holding up. US manufacturers post the biggest increase in orders since spring. Still in contraction territory though, underneath 50, but is rising. New admin, potentially a huge tailwind for US manufacturing. Along with the boom in data center, a need for electricity. US construction spending hits a record high in October, also doubling the forecast. And the Fed themselves, their latest estimate yesterday of gross domestic product, GDP, sum of all goods and services produced in the country, tracking an annualized rate of 3.2%, significant jump from their estimate a week ago of 2.7%. So consumers are out there spending, jobs market is holding on, capital markets are healthy, we're past the election, economic data is trending to the upside. And on top of all that economic and market momentum, we've still got Fed members saying today, rates likely need to come down a fair amount over the next year. It's like pouring fuel on the fire. The economy and corporate profits are growing, and the Fed wants to bring down the cost of capital even further, widening profit margins. And so that's what we call a soft landing Goldilocks scenario. Could very well be similar to 1995, 1996. And actually a great starting point to enact tariffs. Be a lot more difficult to get them passed and more risks if the economy were weak, along with the stock market. However, I'd say with all his strength, he's got chips to play with, in a very strong position to act and negotiate, especially with China in a weaker position. States got a lot of leverage here and likely to get their way in any potential trade wars. Of course, we don't know exactly how all this is going to play out and what China will do back. But the US dollar continues to trade strong. That was the day after the election there. And like a few assets, the market saw it coming. And that's basically markets pricing in a stronger US economy, just like the 10-year has moved up as well. It too kind of in a sweet spot. If it were to go too low, that would be the bond market pricing in a weak US economy. If it were to go too high, pricing in inflation, higher cost of capital. So around these low fours, it's kind of a sweet spot. And high yield bonds still holding on to their yearly gains as well, along with near rock bottom low high yield spreads over treasuries. Simply no stress in credit markets here, and we can see that in bond market volatility, also taking a big dive after the election. Just moving on, you may have heard South Korea briefly went into martial law, but the president soon lifted his order, reversing his declaration hours after announcing it. Bit of a political drama in the liberal democracy home to companies like Samsung Electronics. In the televised announcement declaring martial law, President Yoon cited opposition parties that had made the country vulnerable to the threat from communist North Korea. He also said the opposition party that controls parliament was holding the country hostage, describing the rejection of his budget and other bills as threatening the constitutional order of the country. There weren't any reports of new military threats to the country that could have prompted the declaration. And there's a look at the iShares South Korea ETF, EWY. Certainly caused a sharp sell-off in morning trading. It was down over 7% at one point, just going down to a 15-minute chart there. Dramatic sell-off, however, like we quite often see, big money was waiting there to gobble up the dip, giving us this big nice hammer candle formation on monster volume. Normally only trades a couple million units a day, today 43 million. And it's going out to the weekly chart as well. Bit of a key support zone here. And I think South Korea is an interesting country to invest in. Apart from this recent drama, they normally have a pretty stable economic, social, and political system, leading technology, electronics, and robotics companies, and they could actually be a beneficiary of harsher tariffs on China, changes the economics, which could have some American companies turn to South Korea for the manufacturing of some electronics and other key components. And so maybe all that big institutional money coming in today was thinking the same thing. So moving on to commodities, we've got a bit of a bump up in oil today as traders are starting to think OPEC Plus will extend production cuts. And we'll get to hear more about that when they meet this Thursday. OPEC really wants oil back to around $75, $80 a barrel. They don't want it going into the low 60s and into the 50s. However, that's what America wants. New admin, drill baby drill, along with the new Treasury Secretary, making cheap oil a mandate to unlock the state's full potential of economic growth. But once again, crude's bumping around, continuing to consolidate here in a pretty tight range now, between 72 and 66. And the more we coil up, it's just a bigger move it's setting up for. And there's gold, still consolidating below its 50, with agricultural commodities as a whole just below their yearly highs. And it's a pretty slow news day across the financial world today, so I thought I'd share with you guys some interesting charts. The world's suppliers. Annual merchandise exports of the world's largest exporters. Just 24 years ago in 2000, the States well out in front, 782 billion. Germany, Japan, France, United Kingdom, Canada, China coming in 7th. Fast forward less than a quarter of a century, their exports have more than tenfolded and now 50% more than the States. China exported almost 3.4 trillion of goods last year. That's why they call it the world's factory. But now going forward, there's a big race to who's going to be the advanced manufacturer, automation, robotics, AI, with China and States already in a big race against each other to see who leads in these future industries. And like I said, keep an eye on South Korea because they could also play a role in advanced manufacturing. Here's another one for you. The 100 best companies stock performance is nearly 4 times better than the market. Looking at the cumulative returns from 1998 to last year for the Fortune 100 best companies to work for, up 2,605% versus 709% for the Russell 1000. That's a significant outperformance. And anyone can view the Fortune 100 best companies to work for. Just do a simple Google search for the Fortune 100 best companies and you'll see this list. Number 1, Hilton. 2, Cisco, NVDA, American Express, and just scrolling down to some other well-known stocks. Marriott, Capital One, Box, Intuit, Adobe, Bank of America, Atlassian is an interesting one. Cheesecake Factory, been named by Fortune as the 40th best place to work for in America. They're on the stock market under ticker CAKE. Pulte Group, Visa, another one, Ali Financial. They're an innovative regional bank, ticker symbol ALLY, and actually Warren Buffett's Berkshire Hathaway owns about 10% of the company. ServiceNow, Salesforce, CrowdStrike, and even Walmart's in there. And I'd say Walmart has given one of the most mind-blowing returns this year in the market. Not because they're just up 77% this year, which is a huge gain in itself, but because it's a $750 billion market cap company that's very defensive in nature, normally low volatility, very low tail risk. So the risk-adjusted returns on Walmart this year have been exceptional. That is the risk investors have worn and the return they've received, on top of regular dividend payments as well. But we've seen this stats before with other companies like Glassdoor. Even though this data is a few years old, it showed that investing in companies that are rated as the best places to work significantly outperforms the market. And again, anyone can see this list. Just Google Glassdoor, best places to work. Number 2, NVIDIA, ServiceNow, In-N-Out Burger, Delta, Adobe. But it just goes to show that companies that are rated good places to work, in other words, they treat their employees well, often excel in the stock market. It's like Richard Branson once said, a lot of people in business say, take care of your customer, take care of your customer. Whereas I remember him saying he focuses on taking care of his staff, or what he calls his partners. Because if you take care of your staff, then they'll take care of your customers. And so obviously that does lead to success, as we can see by the data of these companies significantly outperforming the rest of the market. So a pretty good starting point if you're looking for long-term investments. And remember, it's always best to invest in companies that you know and understand, and even a customer of yourself. They make for the best long-term investments. Not just because the numbers in the chart looks good, but because you intimately know and believe in the company. And it's getting back into the charts and looking at what's hot today. Still got the quantum trade catching a bid. Another small cap ripping up there today, along with D-Wave Quantum having a bit of a bounce back. Other hot stocks doing well, Global Star, GSAT. They provide mobile satellite services. Meme Trade is still doing well. Reddit ripping up another 5% today. It's been on a tear these last few months. And even though gold didn't move much today, some of these small cap gold miners catching a bid. New Gold up almost 7% on volume. Same with Equinox, trading firm, and IM Gold. Another small cap miner holding onto its uptrend here today. Still getting pullbacks in other hot parts of the market. Drone operator, Red Cat Holdings, having a bit of a pullback, along with some parts of the nuclear trade. Sam Altman's Oklo losing its 50-day today. Small modular reactor developer, NewScale, SMR, pulling back a bit, along with those EV toll stocks, which got super hot last week. Big sell-off to start the week yesterday. Falling a little bit here again today, along with Joby as well. Did appear to be a little bit of a buy the dip there though. And Rocket Lab, similar story. Early stage, sectors of the future, hot growth, exciting stories. Been really trading up well the last couple of months, having a bit of a breather here today. But overall, the uptrend's still intact. Really need a solid close below the 50-day to say otherwise. And that's pretty much a wrap for the daily market review today, guys. Thanks very much for tuning in with me. And again, the S&P 500 just grinding higher on low volatility here. Another solid rotation in the market into mega cap tech, with smaller names taking a bit of a pullback. And overall breadth, volatility, bond market, credit spreads, all saying the market's still on firm footing. Along with that slew of positive economic data, we'll wait to see what we get this Friday morning when we get the jobs report. Unemployment rate expected to be 4.2%. Otherwise, the market's not pricing in any surprises, and it just seems to be drifting here. That's all for today, guys, and I'll be back again this time tomorrow. Cheers.